entering the names and the account numbers in it. Now this step is to enter the opening balance. So again, the first one is done for you. June 1st, balance brought forward is the explanation. No debit, no credit. The balance is $20,000 debit. And where do you find that from? If you go to your opening trial balance, it's got cash at bank, account number 101, debit 20,000. Then let's do note receivable. So June 1, explanation, balance brought forward, 4,000, 40,000, that's 40,000. Alright, so this one is 200,000. I might have said 20,000. So your cash at bank was 200,000. Your opening balance for notes receivable is 40,000. Now let's go down to opening balance for accounts receivable. And so again, June 1, balance brought forward is 112,000. Now I will do allowance for bad debts. June 1, let me put the 1 in there. June 1, balance brought forward, and that is 6,000, and you'll notice that 6,000 is in the credit column, which it comes up there as a 6,000. If you go down also in the assets under non-current assets, you'll find accumulated depreciation as a credit. So that'll be a bit of a clue that when you get down to this credit item here, this account should be accumulated depreciation. Right, that's getting you through the general ledger. Then we also need to do the subsidiary ledgers, the opening balance. So the first one again is done for you. Arberk, June 1, opening balance, $50,000 debit. E-Air, let's put this in, June 1, opening balance is 12,000. And it will be a debit. Again, you don't really need to put debit in here, and there'll be no marks on there. This is an asset account, so the normal balance is a debit. And M. Flinders, you would find would be June 1, opening balance, and you should be able to look it up and find it's a number, 14,000. Now you continue on that process for all of them. All through your accounts receivable, that's people that owe you money, subsidiary ledger. Let's now go back and see more things you need to do. So on instructions, record the transactions for January to the appropriate journals. Well, let's have a look at the transactions, which you've probably printed off, but if you haven't printed them off, or you want to go here, you may be able to fill this in first and then print it off. Now I've got a column here which has no marks. It's but it might help some of you learn some things or transfer things across. In your journals you have 4 choices as far as the special journals go, and then if the transaction is not entered in a special journal, it will go into the general journal. So what are those 4? Well, we have the sales special journal, or the sales journal, and it records sales that you make on credit. We have the purchases journal, purchases journal, and in it you record purchases that you make on credit. Then we have the cash received journal, cash received journal, and I guess fairly obviously you record cash receipts. So i.e. money deposited into your bank. And we have cash payments and CP, cash payments, journal, and that records cash paid. And that really is from your bank account. So here we're not necessarily talking about hard cash, but typically it's cash now has a definition. You write a check. The most common thing here would be you write a check, or you could have a direct transfer. Now, as well as that is the general journal. G. I've put some notes somewhere on how you should refer to that, whether you call that G or GJ. It's got two things, and that's the general journal. And if it doesn't go into one of these journals, and then it's going to go into the general journal. So let's have a quick test here. You sell inventory on credit. Right? That is a sale. You've made a credit sale. Again, you sell inventory on credit. A sale. You pay freight of $1,000. So that is a cash payment. Cash payment. You purchase inventory on credit. That is a purchase on credit. A credit purchases is P. You purchase inventory on credit. P. You receive cash payment. So that's a cash payment. Well, no, it's not. Just because it has the letters cash payment in there, what this is a sign you need to think about what's happening. You receive a cash payment. So you receive cash. So that's going to be cash receipts. And again, you receive cash. So you can continue to go down here and identify which journal a particular item goes through. Now you don't need to do that, but it may be a good learning experience, and some of you may find it helpful. You've got to identify this, because then it comes to entering stuff in the special journals. So let's move on to the special journals. Now, on this page, what you need to have with you is a printout copy of your transactions. Well, you don't really need a printout. You can keep going back to this page. But if we look on the printout, and I'll show you here, the very first item we have, June the 1st, we've made a credit sale to NB Walton for $50,000. And that's already done for you. That should be June 1. It's not completely done for you. June 1, NB Walton, invoice number 52, distinction. Important thing to understand. By the time you, well, some of you could be into it now, you should have already seen that a journal, if you make a sale on credit, you would debit accounts receivable and you would credit sales. So here we could have two columns, an accounts receivable debit column and a credit sales column. However, because they're always going to be the same, a sale for $50,000 on credit is always going to be $50,000 credit to sale and a $50,000 debit to accounts receivable, so we put them in the one column. So there's the 50,000. Here's something else of significance. When you make a sale, and in this assignment we're using the periodic inventory system, so that means we need to bring to account our cost of goods sold when we bring to account the sale. So what happens cost of goods sold? That's an expense, a debit, and a credit for the inventory. That means an inventory credit, our inventory is getting smaller. A debit to an asset makes it smaller. Now, why have I got $30,000 in here? Well, it's like this. You're told in your special information that your gross profit percentage is 40%. So if your gross profit is 40%, then your cost of goods sold is 60%. So the 40% and the 60% adds up to the total of your sales. Sales less cost of goods sold equals gross profit. So we know this is 60% of that, times 60%, or 50,000 times 0.6 equals 30,000. Let's look at our next transaction, and maybe you can put it in and see how we go. So we've got to sell inventory on credit to E-Air for $10,000. So we know that'll be June the 1st, because that's the date. Now, who's the account debited? E-Air. The invoice number is 53. The amount of the sale is 10,000, and therefore our cost of goods sold is going to be 60% of that, will be 6,000. Now there's one other important thing that I should alert you to. This reference column here stands for posting reference. Now if you make a sale on credit, that means, and your accounts receivable has gone up here, 50,000, we also need to record that NB Walton owes us an extra 50,000. So how do we do that? Well, that comes in our subsidiary ledgers. So what do we need to do? We need to go to, by now you should have entered in what her opening balance was, if you'd work through this. And if I go and look it up now, I see on June 1, opening balance for NB Walton was $20,000. And that's a $20,000 debit. I've got capital D, capital R. You could have capital D, small r, and I guess even if you have small d, small r, that would still work. Or here you could have nothing, even because this is an asset account, you'd expect it to be a debit. You'd really want to highlight it if it wasn't a debit, if it was a credit. So let's have a look on June 1. June 1. We made a sale. The reference here is the posting reference that comes from the sales journal. We made a sale of $50,000. Now the balance is an opening balance of 50,000 plus a debit. Opening balance of 20,000 plus a debit of 50,000. So our balance now is going to be $70,000. Now to indicate that we've done this, when we go back to the special journal, we'll need to put a T in that column, the posting reference. The T stands for tick. So before computers, the forms would look the same, and what we would do here, you just come along and do a tick. But now you could use a tick, but the convention has come as to use the letter T to indicate that this item has been posted to the subsidiary ledger. Then you'll go and you've done the next transaction in here, and that item you would again need to post that to E-Air, the $10,000, and then when that's done you put a T in. Now you'll find when they pay, you'll have to come down here, cash receipts journal, accounts receivable to indicate they've paid, indicate cash at bank, and a reference that they've paid will be a T that you've also